In our fourth video this week, we'll be looking at the price volatility of bonds, we'll be looking at the duration of bonds, and how we can use that duration. Now, bond prices move inversely to bond yields. So we will recall from earlier in our video series that the price of a bond is simply the present value of the coupon payments and the present value of the par value or the principal value, which gets repaid at maturity. Now, as we can see, when we work out the present value of a bond, the yield or the cost of debt is in the denominator in both of those terms. And if R, the cost of debt, increases, then obviously the price of the bond will go down. And that's simply all that we mean when we say that bond prices move inversely to bond yields. So when the cost of debt goes up, the price of the bond goes down. So a useful way to remember this relationship is to remember that bonds are simply a contract where the key term, the coupon rate, reflects investors' required return for bearing risk at the time the contract is entered into. But suppose Company A issues debt at par value and promises to pay investors 8% per year for 10 years. But in a year's time, investors require a rate of return of 10%. So when the company borrows money, it has to promise a higher rate in order to convince those investors to provide funding. So the market price of the company's bonds will fall because investors will want the same 10% return on the promised payments for Company A as they can receive from an investment in the bonds of Company B. The contract terms for Company A's bonds haven't changed, just the market price. So the Company A bonds are still paying the same coupon rate, but because investors are now demanding a higher cost of debt, a higher rate of return, the R has increased, and so correspondingly the price of Company A's bonds must have fallen, so that those investors can receive the rate of return that they require. So for a given change in yields, the longer the maturity of a bond, then they will have larger price changes. So thus, the bond's price volatility is directly related to maturity. Now again, we can see that in the formula. So you'll note that the coupon payments are each discounted by the 1 plus the cost of debt, but it's to the power of time, maturity. And equally, the par value is discounted by 1 plus the discount rate, but again, that's to the power of time, how many time periods there are. So it's important to recognise that the larger the maturity, or the longer the maturity of a bond, then the greater the impact from a change in the cost of debt, because that cost of debt is raised to the power of time. So clearly, the greater the time, the bigger the impact for any change in the interest rate. So price volatility increases at a diminishing rate as term to maturity increases. Price movements resulting from equal absolute increases or decreases in yield are not symmetric. So this is what we refer to as convexity. Higher coupon issues show smaller percentage fluctuations for any given change in yield. Thus, the bond price volatility is inversely related to the coupon rate. And again, you can see that in the formula. So if more of the value is in the first expression, so the sum of the coupons, then those coupon payments are received earlier than the par value. So the average time we have to wait to get those coupons is shorter than the par value, And so the more cash flow that's in those coupons, that is a higher coupon rate, then the less effect the time has, and the less effect from a change in the cost of debt. And so duration measures the expected percentage change in the price of a bond for a 1% shift in the yield curve. That is, interest rates for all bond maturities increase or decrease by the same magnitude. What kind of impact will that change in yield have on our particular bonds? So the way we look at that is we shock interest rates up and down by a small amount. So a small change in delta Y, the yield, and then we revalue the bond. The modified duration assumes that there are no changes in the cash flow, whereas effective duration allows the cash flows to change. For example, an exercise of a callable option. In this course, we're simply looking at modified duration. We're not looking at effective duration, and we're not looking at callable bonds. So how do we work out the duration of a bond? We work out that duration of a bond. So D, the duration, is equal to the new value when the value of the bond falls. So if the yields fall, what's V negative? Minus the value if the yields rise. And they change by that small delta Y. We then divide that by 2 multiplied by V0, the initial value of the bond at the current yields, and then multiply that by the delta Y. So this is an assumed change in yield, and we're doing this just to work out what the duration is. It is not our forecast or our expected change in what the interest rates will be. Delta Y is simply a small change in the yield such that we can work out what the duration is. And so that delta Y is not to be confused with what we expect the yield to change to. Yeah. So to remember this equation, we can think about this in a couple of ways to make it a little bit easier to remember. So if we look at V negative, divide by V0 minus 1, this is the absolute percentage change in price if yields were to fall by delta Y. And similarly, 1 minus V positive divided by 0 is the absolute percentage change in price if yields were to rise by delta Y. And the average of these absolute changes is then simply V negative minus V positive, all of that divided by 2 V0. And further dividing by the delta Y merely converts the duration to the percentage change for a 1% change in rates. And so the other way to think about this is equivalent to the first partial derivative of the value of the bond with respect to the yield. So for a small positive change in Y, then the change in V, as we said, is equal to 1 minus V positive divided by V0. For a small negative change in Y, then the change in V is equal to V negative divided by V0 minus 1. And then if we average the two, you can see that we get V negative minus V positive over 2V0. And to find the change as a percent, again, we simply divide through by the delta Y. So let's look at an example. Our original data for the bond is that we have a yield to maturity of 8%. The bond pays a coupon rate of 10% per annum. The par value is $10,000. So this implies that the price is currently $11,729.20. To work out the duration, we have to have some delta y. And so this is an arbitrary small amount. So we shock the interest rate by this small arbitrary amount, delta y. In this case, we're going to say it's 0.5%. The value, and then we recalculate the value for an increase in the yield to maturity. So we go from 8% to 8.5%. That's our new increase in the yield to maturity. And so obviously if yields go up, we would expect the value to go down, and that's what we find. We find a V positive of $11,258.43. The value for a decrease in the yield to maturity, so in this case we go from 8 minus 0.5% is equal to 7.5%. So now our V negative will be $12,228.66. Again, that's expected. If rates fall, we would expect the value of the bond to rise. We then use the duration formula using those new values, and we find that the duration is 8.27%. And so how do we interpret that? Well, that's telling us that the bond price will change by roughly 8.27% for a 1% change in the yield to maturity. So how can we use this duration? So we can use that for particular trading strategies. So longest duration bonds or securities provide the maximum price volatility. So if we expect a decline in interest rates, then an increase in the average duration of our bond portfolio will experience the greatest price volatility. And if rates are going down, that would mean the prices would go up, which would be great. However, if we expect that interest rates will rise in the future, then we may want to reduce the average duration in our portfolio to minimize the price decline, so that capital loss that we'd incur if rates go up. And the duration of our portfolio is the market value weighted average of the durations of all of the individual bonds in the portfolio. So this gives us a way to quickly calculate what's our exposure to interest rate changes for the entire portfolio of bonds. In our next video, we'll look at convexity and how convexity can be used to more accurately estimate this price volatility of bonds. Thank you.